What's up YouTube? Welcome to Wise Wealth, where we discuss all things personal finance, from budgeting, investing in the stock market, to a few tips and tricks that you may not know about to help you make a little bit of extra money. Be sure to hit the subscribe button and hit the bell icon to make sure you're notified of the new videos that I release. Now, I must caveat this video by saying that this is not financial advice and is purely for informational purposes. Without further ado, let's get into today's video. So today we'll be exploring why investing in a dividend stock can actually lead to significant growth value in the amount that you invested. Now, if you're new to the concept of dividends and the stock market in general, I have a video on my channel that explains dividends in a bit more detail, and I'll leave a link to the video in the description below. Now, if you're investing in high dividend paying stocks, you're probably in it for the revenue stream that it generates over time, something that's commonly referred to as passive income. So the company you invested in will pay out your dividends over a specified period of time based on the number of shares that you have invested in the company. So the more shares you own, the more you'll get paid in dividends. But what if your dividend stock that pays you regularly were to significantly appreciate in value over time, giving you a substantial increase in your asset value? Well, I'll take that. And actually, you'll be glad to know that this is actually quite a common occurrence in the stock market. And in today's video, we'll be looking at why this happens and what in particular contributes to that, and why you as a dividend investor should be looking at this. So let's take a look. So the first element we'll be looking at is the earnings per share. This is basically how much a company makes for each share of its stock. Higher EPS is a widely desired metric by companies and investors alike, as a company with higher profits is a company that can pay out more to its shareholders, so you can expect dividend growth over time. A useful way to look at this is to look at a company's dividend history. So take a look at its dividend payouts over time and its earnings per share. You'll notice that if earnings per share is rising, the subsequent dividend payouts will increase as well. And dividend companies will look to do this steadily over time, as it gives investors confidence in the growth rate of the company and their investment. Now, this leads me on to the next calculation to look for, earnings per share growth. So earnings per share growth over time suggests that the company is on an upward trajectory, and its products or services are in strong demand. Earnings growth is even considered essential to a stock's success, and has the greatest impact on its future price performance. Now, this is a fairly straightforward calculation. You take the earnings per share and you subtract it by the number that preceded it 12 months ago. For example, if a company's EPS was reported at £1.25 this year, compared to its previous year's earnings per share of £1, then we subtract the current year value from the previous year to give the growth. This is expressed as a percentage, and so is calculated by dividing it by the previous year's earnings per share and multiplied by 100. Giving an earnings per share growth rate of 25%. Now, if you were to spot a company with a reported EPS growth rate of 25% year on year, this would be a highly attractive investment, as your expected dividend payments would look to increase steadily over time. In turn, this would drive up the price of the shares, and if you had an investment in a company such as this, you'd realize significant growth in the stock's value, and your initial investment would raise in value over time. So let's look at an example in history where this has proven to be highly successful for investors. To look at this in action, let's go back to 1960 and look at two separate dividend-paying stocks. Procter & Gamble, which has paid out dividends every year since 1891, and Merck, which has paid dividends every year since 1935. What a track record for both of these firms. Jeff here thought it would be best to put some of his cash to use and wanted to get into investing. He looked at their consistent dividend-paying history and thought that the steady stream of income he'd get would be a positive financial step forward. And so, he invested $1,000 in each of these companies back in 1960. What Jeff didn't consider was how much growth these firms would see over the next few years. Let's look at what Jeff's investment looked like 30 years later in 1990. Over that time period, P&G averaged an earnings per share growth of 8% per year, while Merck averaged a staggering growth rate of 14.8% per year. Due to its massive earnings growth, Jeff's investment of $1,000 each was now worth more than a combined total of $51,000. This just goes to show the power of time when investing. Since these great companies were given such a long time to grow their business and their share value, Jeff has seen an immense rise in his assets value. To put this into perspective, let's have a look at what his dividend payments were in the year 1990. From an initial investment of $1,000 each, Jeff was receiving an annual dividend payment of $222 from P&G and $894 from Merck. That's over 50% of a return on investment. His dividend payments cover over time has massively outgrown his investment value back in 1960, and he continues to get that steady stream of income passively. This really goes to show that when investing, you should be in it for the long term to realize those massive benefits. If you look at the market over time, history tells us that investments do well over a longer duration. While you may realize losses in the short term, like we have seen in the recent months, going against the market and not selling when everyone else is can really pay off. In fact, investing when everyone else is selling can give you the ability to buy great companies at a discount. As one of the great investors of all time, Warren Buffett said, "You should be fearful when others are greedy, and greedy when others are fearful." At the end of the day, the stock market is a massive sum of transactions between human beings, and human beings are led by emotion. Fear can run rampant through the market, causing wild overreactions and mass sell-offs. Don't let your investment strategy be guided by emotion. So that's it for today, folks. Thanks for tuning in. Be sure to look out for these metrics when looking at your next stock purchases, and you can even go through your current portfolio to see what your stock's history looks like. Let me know in the comments below what dividend stocks you have in your portfolio. I've got a short list of my upcoming investments, but I'd be keen to hear what yours are. If you're enjoying the content, be sure to hit the like button and let me know. Remember to subscribe, and until next time, see ya.